Good afternoon. Time to check in on those markets. Global shares rose as the dollar eased ahead of U.S. jobs data that could offer a steer on the outlook for interest rates, and the rand happening to strengthen in early trade as some risk appetite returned to the markets. Investors are trying to determine the impact of OPEC Plus' decision to reduce daily oil production by 2 million barrels. The price of oil currently trading at $93.85. Meanwhile, Saudi Arabia's energy minister said the real-world impact of the cuts would likely be around 1 million to 1.1 million barrels a day from November, given that some alliance members are already pumping well below their quotas. That still equates to the biggest reduction since the start of the pandemic. However, we are joined by Carmen Mpelwana, who's a portfolio manager at Absa Asset Management, to give us some perspective on the markets. Carmen, thank you so much for your time. I mean, you have an Asian performance that was rather mixed, and we're still kind of trying to reconcile the OPEC Plus decision. On the back of that background, how is our JSE holding up?
Yeah, so this morning we opened up quite strong, and that was on the back of the strength in the US market overnight. Following some news there, we did see a bit of an uptick, and we saw that come through in this morning. There's been a slight pullback down to, well, we're up about 35 bips at this midday. And a lot of that has come through from the resource sector. That was down significantly. And then we've seen some positive moves on the retail and the bank sectors.
What do you make of the current, intraday volatility that we've been seeing, especially as well when you look in the run up to the beginning of October?
Yeah, so if we go back and look at the equity market volatility index, we're seeing levels of about 29. So just to put that into perspective, a level under 17 is kind of where you want to be. So 29, definitely exceeding that. During the GFC, we got to a level of about 43. So just as an indicative. So I think the overriding factors have been the geopolitical risk. So, and we definitely did see when the BOE came out with the announcement to cut the top tax rates, market definitely moved negatively. And once they did revoke that a few days ago, we saw the market recover again. So as we've well seen, when we see the Fed, any of the Fed governors or presidents come out and speak and make comments, that also moves the market. So definitely a big theme of macroeconomic impact.
So I mentioned in my intro that you have OPEC Plus agreeing to that large production cut. What has been the market reaction and also the impact going forward? What does that look like?
Yes, I definitely think this was expected. It was probably the worst kept secret. We had been seeing numbers between 500,000 and then in the last few days up to the 2 million level that they have announced. And the initial reaction by the Brent crude price was up 2%. The motivation behind this pullback or the cuts from OPEC Plus side was related to the fact that they're trying to put a floor on the oil price, so at about the $90 a barrel level. And that's kind of where it is. But we're also seeing a reaction out of the US, where they, in response, have said they will increase their output to try to alleviate, because the Northern Hemisphere is going into winter, and we expect demand across US and China to go up. And we already have this energy crisis, so lots of concern around that. Add to that the first stage of the EU sanctions against Russia are due to come into effect on the 5th of December as well, which will see some more supply come out of the market directly. So it doesn't look good at this point, but a bit of a mixed bag.
So let's take things stateside. You have data coming in. You're looking at Fed comments coming out of the San Francisco Fed President Mary Daly, cooling the hopes of a potential Fed pivot, which then makes you wonder, why is the market still holding on to the idea of a Fed pivot, given how high inflation is?
I think the market is holding out hope that we'll be able to avoid a deep recession. So hoping that whatever the Fed's going to do will sort of lead to a soft landing. Having said that, the Fed is going to be cautious. That's the stance that I would take. Unfortunately, some of the macro data that has been coming out is showing that the impact of interest rates rising in the US are actually having an impact on growth. So we are looking for some numbers for the rest of the week in terms of the stance the Fed will take going forward. We did see some not job numbers, but numbers that said there were less 1 million new job openings that were available. And so that just gives an indication that there seems to be a slowdown from the employer side and their demand for labor. And that's what the Fed's looking for.
Right. So, I mean, everyone talks about a Fed pivot as though, you know, it's a bullish sense of things in and of itself. But what would happen going into 2023 that we have a Fed that rather pauses with no cuts right up until, you know, the end of the year and is actually willing to tolerate 3 quarters of negative growth? What does that mean for the market?
Yeah, I think the market's trying to avoid that, but I think at this point, especially with the rhetoric out, as you've mentioned, the Fed president saying that they're likely to continue to, their primary focus is to look at inflation. So if they can't get inflation down, their concern is around the consumer and how wages are being deteriorated by higher inflation. So that will be the focus. If they don't see that number coming down, they're likely to continue to increase. And that's what's priced in at the moment, that they're likely to be increases up until early in the first quarter. Having said that, historically, we've seen that the Fed generally will take a pause, as you mentioned, and that pause generally is about 6 months. The basis of that is to see the actual impact of whether the rising interest rates are actually causing a slowdown in the economy. If not, then there should be other actions taken. But as it stands, it's after 6 months, they would likely start cutting the interest rates. So as you mentioned, if it is pushed out into the latter part of 2023, I think we may be in for a bit of a harder landing that the market is hoping for.
With just under a minute left to our discussion, tomorrow's expectations for the non-farm payrolls, what are we looking for?
Yeah, so Bloomberg consensus is looking for 260,000. Non-farm payroll numbers. This is compared to the 315,000 that we saw in August. And again, as I've mentioned before, just looking for that to continue to come down and going in the right direction. So if there is a beat, so it comes in lower than that, I expect to see a bit of a rally in the market. But that will give us some insight as well.
Carmen, thank you so much for your time. That is Carmen Belona from Absa Asset Management.